Welcome back everyone, this side Mayank Kothari. Today we are going to start a new chapter, that's mergers, acquisition and corporate restructuring. This is going to be the last chapter of our fast track batch and we are going to enjoy this chapter a lot. Why? Sir, first of all, this chapter has lots of basic understanding related questions. First thing. Second, it will be a stress-free chapter for you because this chapter doesn't have a lot of formulas to remember or technical formulas like portfolio had, derivatives had. So this chapter is not going to be that difficult for you. Plus this chapter is important from the exam as around 16 marks of the questions will be asked minimum from this chapter. You can expect around 2 questions of 8 marks. And if the institute is happy with this chapter, you can also expect 4 marks of theory question as well. So 16 to 20 marks of the question can be asked from this chapter. This is one of the chapter which is equally important from the theory as well as practical point of view. Theory for 4 marks and practical for 16 marks. It has a lot of theory. If you will go through the theory volume, the 3rd volume of compiler, you will see that this chapter is having a quite good amount of theory to study. Okay sir, nevertheless, this is going to be an interesting chapter for sure. I will make that. Okay, so this is coming in your 5th section according to institute syllabus. This is the 13th chapter, second last chapter, and this is the only practical chapter we have in the fast track batch. Startup finance also has a couple of questions that we are going to discuss after the mergers and acquisition chapter is over, but I'm not counting on that. I will just take around half an hour to discuss that chapter, that 2 questions that are there in the startup finance. But startup finance is purely a theory chapter. You should prepare theory for 4 marks from this chapter. Okay sir, let's discuss about the concepts that we are going to study. See, there are around 65 questions in the mergers, acquisition and corporate restructuring. A lot of them are repeated questions as well, and that will help you to build up over the concepts and revision as well. But if you have if you don't have much of the time, then you can use the important questions list so that you can check out all the repeated questions and just focus on the questions that you can cover all the concepts from. Okay, first of all, I will just go through one by one every concept so that it will just get into your head, and then by the time we will study all the questions, we are going to go through these. The first one is the purchase consideration or cash or shares. Like whenever we are going to ask for a company to get merged with ourselves, or we are going to buy a company, there will be something called as purchase consideration. In order to buy anything, whether it is a Parle-G biscuit or a company, you have to pay for it, and it can be paid in terms of cash or shares. So that there will be 2 options. Most of the time this option will be covered. Out of 65 questions, you can see around 60 questions will have this option, that the purchase consideration is being paid in terms of shares, not cash. But yeah, there are 2-3 questions where the cash consideration will also be discussed by us. Then the second thing is the synergy benefit. Like whenever you acquire a company, whenever you buy a company, whenever you get merged with a company, another company, there are some synergy benefits which will help you to grow the business of both the companies. Like in the synergy benefit terms, it is being said that if the value of one company is let's say value of one company is, just a second, 1, and the another company is 1, but when they get merged it becomes 3, not 2. That is, that extra 1 that has been added in the total value is called as the synergy benefit, because 1 plus 1 is going to be an independent values of the companies, but 3 is the merged value of the company, and the difference between this 3 and 2 is called as the synergy benefit. Okay, we will discuss about that also. The third part is the exchange ratio or the swap ratio. See, whenever you will be discussing about the purchase consideration in terms of shares, you will have to give the shares, give your company shares to their company shareholders. So there will be a kind of a concept called as exchange ratio, that for 1 share of their company, how many shares you are going to give of your own company. let's say for example the exchange ratio is 5.5:1. That means for their company's one share, in order to buy their company's one share, you will give your own company's zero point 0.5 shares, because the situation might be their company's share value is, let's say, 10 rupees and your company share value is 20 rupees. So 10 rupees of one share and 20 rupees of half share is one and the same thing. So that's why you are getting only half of the shares for buying their single share. Okay, after this exchange ratio, after calculating this exchange ratio, that how many shares you are going to offer to them, you are going to calculate that in total what will be the post merger number of shares. Let's say for example their number of shares are, they have a number of shares like 10 lakhs, right? And if you offer them 0.5 shares of your own company, that means the total number of share will be 5 lakhs. So in order to buy their 10 lakh shares, you are going to give your 5 lakh shares. So that's what the exchange ratio is going to help you for calculating post merger number of share. Then comes the post merger earning per share. What happens after merger? How do we calculate earning per share? Earning per share is very simple, sir. You can calculate total earnings of both the companies like this, like earnings of company A plus earnings of company B. After merger, the earnings of another company will get merged into your company itself, right? And number of shares of company A that it had plus the new shares that you have issued, like 5 lakh shares. So this is going to be total earnings divided by number of share. The concept of EPS will remain same, total earnings divided by number of share. But post merger earning per share means what is the post merger earnings in the numerator and post merger number of share in the denominator. Then comes the post merger market price. It's very simple, sir. Once you have calculated the EPS, what you can do is you can use that post merger EPS in order to calculate the post merger market price. See, the formula for the market price is EPS into PE ratio. If you remember that in the last chapter also we have used it. So if this EPS is post merger, the market price will also be called as post merger, right? Okay, then we can prepare the post merger balance sheet. After that, after merger, we will also try to find out that what is the benefit in terms of EPS to the shareholders of both the companies due to merger. Both the companies have decided to merge, right? And this is our responsibility to calculate what is the benefit, or if there is a loss to any of the shareholder in terms of EPS. Then there is something called as equivalent earning per share that we are going to focus. Another thing is gain or loss in the market value due to merger. This might happen that if the market value of the two companies, let's say 100 crore and 50 crore. So once these shareholders come into this company, acquirer, their market value may get increased to 70 crore. So practically speaking, there is a benefit to them of around 20 crore because they had a market value of 50 crore before merger and now they have a shares of 70 crores of this company, the acquirer. So practically speaking, in terms of market value, it is a 20 crores addition to them. So that's a gain or loss to the market value. This is where we are going to finish our first phase of basic understanding of the mergers chapter. So this blue area or the first 10 points are going to explain you the basic understanding of the mergers chapter, and this will help you to build up the link of this chapter, and that is going to help you in the rest of the concept. The second phase will start from here, where the next level of questions will be discussed. I want to say that next level of question doesn't mean lengthy question. It can be a small question, but now you will have to increase your intellectual level to solve these questions. So true cost of merger, buyback of securities, promoters holding, what is free float holding, free float market capitalization, bonus ratio and stock split. These are the concepts that we are going to discuss in the second phase of this chapter. And you might be getting some hint that, yeah, reading these concepts was quite easy, or like you might be feeling comfortable by reading these concepts than these one. So there will be something called as true cost of merger, where you are going to find out how much extra you are paying to buy that another company. Buyback of security, whenever the company is going good and they feel that we should buy back certain shares from the market. So you can offer some money to the public and you can buy back the securities. So this is about that. This comes with the promoters holding and free float holding. The total market value of the company will be divided into two parts, like promoters holding and free float holding. Promoters holding means the promoters or the owners of the company who are holding some shares of the company, and free float holding is the holding that is floating. That means that is available in the market to buy and sell. Those shares are available in the market on the stock exchange to buy and sell. A lot of people who are buying the shares every day from the another shareholders are buying from this holding, because this is freely floating in the market. That means the owners of these shares are floating. That means changing every second, every day, every month. Normally what happens is promoters do not sell their holding, and that's why this will not change. The ownership of these shares will not change much as compared to the free float holding. That's why the name goes with this, free float holding. That means the owners of these shares will keep on changing. Then the market value of those number of shares is called as free float market capitalization. Bonus ratio and stock split is going to be one of the concepts. Okay. Then the third phase of our chapter, which is going to be another level that is going to be difficult from the second level as well. So I have divided the phases in terms of the difficulty level. So the moment we will feel that, okay, now the third the difficulty level has increased for this chapter, we are going to solve these type of questions like capital adequacy ratio, non-performing asset, what is maximum and minimum exchange ratio that a firm should demand in order to buy or sell the company, divestiture decision, and corporate restructuring. Let me talk about the maximum and minimum exchange ratio. Maximum will be decided by the buyer, that I am going to pay only 20 crore to buy this company, and minimum will be decided by the seller, that I am going to I am demanding at least 25. Minimum means at least 25 crore. So what will happen? The minimum amount is always decided by the seller. Buyer is not worried about the minimum that he should pay, because for a buyer he will always want to pay less, and for a seller he will always want to sell at a higher price. Remember that buyer will always look for the lesser price and the seller will always look for higher price. So that's not the concern. The concern for both of them is how much maximum a buyer should pay so that his decision does not go wrong, and how much minimum a seller should request or demand so that his decision does not go wrong. So what will happen if the buyer is saying that I am going to pay maximum of 20 crore, the seller is saying that I am going to at least sell my company at 25 crore. So both the parties will negotiate, and somewhere like 22 to 23 crore will get negotiated, and the final price. The seller has to come down from his minimum demand, and the buyer also has to go above his maximum demand. So somewhere like 22 23 crore will be the final price if both of them really wants to buy and sell the company. So this is what happens. Divestiture decision is like separating an entity or a business segment from the existing company and forming a new company with that. So divestiture decision is like, let's say for example, I am running a conference on X Private Limited, and in which I am running the video lectures department and the books department as well. So if I want to take the divestiture decision, what will happen? I will divest my books department to another company. Let's say for example, Conferenza Books Private Limited, and Conferenza Next Private Limited will always be into video lectures. So if I go ahead with that, that will be called as a divestiture decision. This is generally done in order to first of all focus on the main business of your company, or just focus on the profitable business of your company. This is a part of corporate restructuring. So another thing is corporate restructuring. Whenever a company is not doing good, they can ask the banks for waiver of the loan, and they can restructure their company. They can ask the equity shareholder also to waive some of the amount. So we are going to look at those questions as well. Now from this point onward, we will be starting we will start finishing the chapter. We will be on the last of the chapter, geared and ungeared beta. We have discussed this in the last chapter. Capital structure decision, Gordon's growth model, discounted cash flow method model, CAPM, and external fund requirement. So these are not going to be the difficult questions. The questions mostly will end here or here at this point 23. The last 4 to 5, 3 to 4 concepts are just common concepts that will be used throughout the chapter. So mostly you can say your chapters or the number of questions will end up on the 23rd point itself. That's it. So this is what we are going to discuss. This is just a summary that I gave you in the last 10 minutes about what we are going to discuss. Even if you have not understood some of the concepts, that's all fine, because whenever we are going to discuss the question, we will take everything and discuss everything out of this list. So this was all about the mergers and acquisitions, sir. We are going to start with the first question after discussing a basic operating structure of a company. That what are the things that you have to remember? Let's have a look. See, it all starts with a basic operating structure, like we are going to say this is a sales, right? Then what happens is we deduct all the costs, or we can say operating cost. It's better to say operating related expenses. So operating cost to reach at EBIT. Earning before interest and tax, right? And once you deduct interest out of it, you will reach at EBT. So once you deduct tax out of it, you will be getting the earning after tax. Earning after tax, right? And there is something called as a preference share in your company, for which you should pay preference dividend. So this will be called as earnings after tax for equity shareholders. So this is very important. A lot of people miss out on this information. Okay, once now from this point, please understand, this point was important till this point. From sales to this point was very important for the corporate valuation chapter, but from this point onward is going to be very important for the mergers and acquisition chapter. So what happens is earning after tax, when you divide the number of equity shares, you get the earning per share, right? When you multiply it with the PE ratio, you get the market price. When you multiply this market price again with the number of share, you get market value. And this market value, the total market value we can say, is divided into two parts: promoters holding and free float holding. Understand the concept. Promoters holding is the shares or a percentage of shares held by the promoters, and free float holding is the percentage of shares which is freely available and mostly held by the public, which are ready to give up their shares for a better price in the market. So the owners of those shares keep on changing from time to time. So promoters holding is, let's say, 30%. Free float holding is, let's say, 70%. Okay. When you divide the promoters holding by market price, or we can say when you multiply it with the market price of the equity share, you get market value of promoters holding. That's very easy, and this is also called as free float market cap. capitalization. So this is basically, you need to understand from this point to this point. This will be used by us a lot of time. Just this much of the part. So if I ask you how to calculate the P ratio, then please understand you can calculate it through this way also, through this way also. So if you divide the market price by earning per share, you can also calculate the P ratio. Or if you what we can say, if you want to calculate, let's say for example, market price, you can do that by dividing the total market value with number of shares or multiplying the EPS with P ratio. So there will be two different scenarios to calculate any single thing. If they ask you to calculate earning after tax, you can go by this method also, or by this method as well. Okay. Once you understand that single shares earning is multiplied by P ratio, then you get the market price. Can I say that if the earning after taxes when multiplied with the P ratio directly gives you the market value, because in between there are only number of shares, which is the difference. So if you get the total earnings to multiply with the P ratio, you can also calculate the market value directly. Now, this is what we are going to use in the beginning. Rest of the concepts we are going to discuss after solving some questions. So let's begin our journey of mergers and acquisition with the very first question. Come. Acha, one of the things that I still want to discuss with you before starting it. Let's say for example, this is a company and this is another company. Okay. There are two companies. In most of the questions in mergers, there will be two companies. One company will be ready to buy another company. The another company will be ready to sell themselves to the other company. So the company who is going to be a buyer will be called as acquirer. The company who will be the seller of itself will be called as the target company. We can call them acquiree as well. Acquirer is also called as purchaser. This is also called as vendor or seller, right? Mostly we will be using these terms. Instead of buyer and seller and purchaser and vendor, we will be using these terms, acquirer and target. Okay. Now, let me just put it here. And these names on this upper side. So this is acquirer, this is target. Cool. Okay, so let's take an example that there are some shareholders of this company target. Okay. So these are the shareholders. Obviously, these shareholders are holding all the shares of target company, and if acquirer company wants them to convince to sell all the share, that means if you want to buy the target company, you have to buy all the shares from the shareholders. That means the entire ownership will be given by these shareholders to the acquirer company is the shareholder. Now, for that purpose, A Limited, that means this acquirer company has to pay something to the shareholders. That is called as purchase consideration. We will be paying something to these guys, that is called as purchase consideration. Okay. Now this purchase consideration, that means the amount to purchase the entire company, can be paid in two different forms. You can pay them cash straight away. It's a very simple deal. When you pay 5 rupees to buy a Parle-G biscuit or 30 rupees to buy hide and seek packet, that's just a cash deal to buy something. In this case also, in order to buy this company, you can pay them cash and ask them to go home. From tomorrow onwards, the company is yours. You can handle your company now. So that's a cash deal. That is called as acquisition in terms of cash. Okay, but most of the time in this chapter also you will be facing this situation of share to share exchange. Share to share exchange. That means in terms of shares, you are doing the acquisition. You are buying the shares of these shareholders by giving the shares of your own company. These shares, just understand, these are the shares of acquirer which will be given to the shareholders of target company. That means after merger, this company, target company, will be merged in the acquirer, and the post merger acquirer company's shares will be given to these shareholders as well. So the shareholders of target company will become the post merger company's shareholder as well, along with the existing shareholders of acquirer. So after merger, company will have two types of shares: the existing shareholders, the old shareholders we can say, and these are going to be the new shareholders to some extent of the acquirer, because their company is now merged in the acquirer. So that's why they have got the shares in the acquirer as well. And that's good for the acquirer too, because arranging so much of the cash is a headache. You will have to borrow money and unnecessarily pay the borrowing cost on that if you want to pay the cash to the target company. Okay. Now, it's easy to solve the questions related to the cash acquisition. We have the very first question related to cash acquisition, and let's have a look on that first before moving over to the share to share exchange ratio. This is the first question. See, A Limited, acquirer company, and its capital is 2 crore rupees. Both A Limited and T Limited, which is the target company, have arrived at an understanding to maintain the debt equity ratio of 0.3:1. What is the equity of the acquirer company? It's 2 crore. Right? If you want to maintain the debt equity ratio, the debt in the company should be maximum of 60 lakhs. Am I right? If 2 crore is the equity, what should be the maximum amount of debt? 2 crore into 30%, that's 60 lakh rupees. So they have agreed that after merger, company should have the debt of maximum of this much. Okay. Pre-merger debt outstanding of A Limited stood at 20 lakh and T Limited stood at 10 lakh rupees. So try to understand this. Like question number 1. This is A, this is target. Okay. And this is merged company A. Now, before merger situation of equity of A Limited is this 2 crore. This does not matter. And then this merged company will also be 2 crore. I will tell you why. Chalo, let's check this point first. What is the debt amount right now before merger of both the company? 20 lakhs and 10 lakhs. Okay. Now what is happening? Let's have a look. Yeah, from this point. And marketable securities of both the companies stood at 40 lakhs. Marketable securities. This is of both the company. That means I can take it here as well. 40 lakhs. The bifurcation is not given, so that's okay. But what do you mean by marketable security? This is as good as cash balance in your bank account. It can be shares, investment in shares that you can sell it tomorrow. It can be investment in money market instrument that you can redeem at a short notice within 7 days, 30 days, etc. So marketable securities means the securities or the investment that can be converted into cash easily. So this is as good as cash balance. Okay. Now what is the question? The question is, you are required to determine whether liquidity of the merged company, liquidity means do you have sufficient cash balance to buy the other company, shall remain comfortable if A Limited acquires T Limited against the cash payment. with a mutually agreed price of 65 lakh rupees. So I try to understand, T Limited will get 65 lakh rupees in cash. So that much of the cash should be there with A Limited. Do you think the cash is there? Yes, sir. We have the cash. First of all, try to understand that since we are paying the shareholders of T Limited a cash amount, the equity shares, we are not giving equity shares of our company to those shareholders. That means the equity shareholding will remain same after merger. Same shareholders of A Limited before merger will remain the shareholders of merged entity. Okay. Now, question clearly says that both of them agreed on the debt equity ratio of 0.3:1. That means the maximum debt that this company can have is 60 lakh rupees. Merged entity can have is 60 lakh rupees. But you can see the existing debt of both the companies only 20 lakhs and 10 lakhs. That is 20 lakhs and 10 lakhs, 30 lakh rupees. So what is the issue? The issue is very simple, sir. We can have 60 lakh rupees of the debt and we still have only 30 lakh. That means we can raise more debt to fund this acquisition. The entry will be cash account debit by 30 lakh and debt account credit by 30 lakhs. We have the 30 lakhs, we can raise 30 lakhs more, the total will become 60 lakhs and that's the maximum limit to keep the debt in the company. So in that process, what will happen? We will get 30 lakh rupees in cash. We have the marketable security which is as good as cash. So I can say after the merger, I will have 30 and 40, that is 70 lakh rupees of the cash. And in order to buy this target company, I will only need 65 lakh rupees. So out of 70 lakhs, I will pay 65 lakh rupees and I will still be left with 5 lakh rupees. So cash is not an issue. Liquidity is not an issue. I still am using 5 lakh rupees. So that's the answer. Have a look. Debt capacity of the merged company is 2 crore into 30%. That means 60 lakh is the capacity. Existing debt is 30 lakh. We can raise more debt. Scope to raise more debt is 30 lakhs. That will increase cash balance. So 30 lakhs of cash plus marketable securities, 70 lakhs of cash and cash equivalent is there with you, out of which you can fund 65 lakh rupees and still say that yes, the situation is comfortable. Liquidity is not an issue in this question. That's how the cash deal is done. There are few more questions on cash only. We will look after those questions later on. Let's have a discussion now on the second part of the acquisition, that is shares. Now, whenever you have to issue your own company's share in order to buy their share, their company share, you will have to decide that what will be the basis of exchange. Are you going to exchange their one share for your one share? Are you going to exchange their one share for your 0.5 shares? Or are you going to exchange one share for your 2 shares? What is the exchange ratio? See, exchange ratio is based on a typical basis, that what is the price of your share. Let's say, for example, price of your share is 100 rupees. So that means every share is worth 100 of your company. And if the price of my share is 200 rupees, then it is not fair to give you one share of my company for one share of your company. Because why would I pay 200 rupees just to buy 100? Nobody does that, right? Let's say, for example, Parle-G biscuit. The worth of that biscuit packet is 5 rupees. So what we do in the transaction with a retail shop is we take the product worth 5 and give 5 rupees in cash. So we both exchange 5 rupees in terms of biscuit and in terms of a cash. So in this case also, whenever you are supposed to give your shares to the target company, you should give them only that much of the value. Shares worth only 100 rupees. So how many shares of your company is worth only 100 rupees? It's 0.5. Because 0.5 multiplied by, understand, 0.5 multiplied by 200 is 100 rupees. That means if you give 0.5 shares of your company, that is exactly equal to, just a second, 0.5 shares of your company is exactly equal to 1 share of their company. So now we can say that 100 is equal to 100. That means this is the exchange ratio. This exchange ratio that I just calculated was on the basis of market price, 100 and 200. The basis can be any other factor as well, like earning per share. Let's take an example. Let's say that the earning per share of target company is 5 rupees. So every share is earning 5 rupees in the target company, and let's say the earning per share, let me just keep it simple, 1 into 5, that's 5, and the earning per share in my company is 20. So do you think it is fair to exchange 1 share for 1 share? No sir, because why would I give them my 1 share which is earning 20 rupees for their 1 share which is earning only 5 rupees? So how many shares are you going to distribute to them? The basis is simple sir, the calculation is simple. Distribute so much of the share that those shareholders will get their earning per share which was there before merger. Before merger every share was earning 5 rupees. Give them only 0.25 shares which will give them earning of 5 rupees. Because our 1/4 share is sufficient enough for their 1 share to give the same earning that they were having before merger. So don't go on the numbers, go on the values. They are still getting 5 rupees of the earning in 0.25 share which they were getting in 1 share in the target company. So this is called as exchange ratio. How I decided 0.25? How did I decide 0.25? It's very simple. Earning per share of their company 5 divided by my company 20. 5 by 20, 0.25. So target company's EPS divided by acquirer company's EPS will give me an exchange ratio. Okay, let's have a look. In order to give the shares of your company, you will have to decide the exchange ratio. And this exchange ratio can be on multiple bases. It can be on the market price, it can be on the EPS, it can be on let's say PE ratio, it can be on non-performing assets as well. Non-performing assets, we will discuss about the non-performing asset later on. But let me just go through the market price first. We had discussed that the market price of 1 share of the target company was 100 and the 1 share of the acquirer company was 200. Then how did we decide the exchange ratio? It was 100 by 200. 100 of the target company by 200, that's 0.5. So what was the formula sir? It was target by acquirer. 100 by 200, that's 0.5 shares for 1. What does that mean? This is acquirers, this is target company share. For every share, in order to buy every share of their target company, we will give them 0.5 shares of our company. Acha. What happened in case of EPS? It was target by acquirer, that is 5 by 20, that was 0.25:1. That is again 0.25 shares of our company for 1 share of their company. But what will happen in case of PE ratio? Just understand, what if the PE ratio of this company is 100 and the PE ratio, let me just change the color, 100, and PE ratio of my company is 50. What will happen in this case? See, if you do the same formula, if you take the same formula as target by acquirer, you will be giving them more shares. 100 by 50, that means 2 shares of our company for 1 share of their company, which is wrong. Because you need to understand the concept of PE ratio. This is acquirer, this is target, and the PE ratio is 50 100. Earning per share is 1 and 1. Understand the logic. What does this mean? 50 rupees is the investment or market price you are required to pay to buy the shares of acquirer to earn 1 rupee in return. That means every 1 rupee of earning in acquirer demands 50 rupees of the investment, and the same 1 rupee of earning in target demands 100 rupee of the investment. As an investor, in order to earn 1 rupee, which company will you choose? It's simple, sir. You will choose acquirer with a low investment. So you will choose acquirer with a low investment. So what is the answer? P ratio lower is the better. P ratio is a negative factor, sir. Whereas market price was positive, higher the better. Earning per share was positive, higher the better. P ratio is negative factor. It's not higher the better, it's lower the better. So you can see that acquirer company is on a better side, better side than the target company. So why would you give a ratio of 100 by 50 as 2:1? That means 1 share of target is capturing 2 shares of acquirer. No, we are paying double, like 4 times, you can say, almost, of what you should pay. The question is very simple, sir. You need to reverse the formula now. It should be 50 by 100. That's 0.5 shares for 1. And it's very simple. See, for their 1 share, you should give only 0.5 share. For their 1 share, you should only give your 0.5 share because you are in a better position. So now the formula is acquirer by target. So understand the logic. When the formula is positive here, when the factor is positive, the basis of exchange is positive, that means higher the better, you take the formula as target by acquirer. And EPS is also positive, higher the better, target by acquirer. But when the P ratio is considered, it's a negative factor. This is also negative factor. So you will take acquirer by target and acquirer by target. I will give you one more example just to make it clear. Let's say loss per share. Let's take a loss per share, A by T. This is loss per share. Let's say your company is having 10 rupees of the loss on every share and target company is having 50 rupees of the loss on every share. So which is on a worst situation? This company is not in a good situation because it is giving a loss of 50 rupees per share. And if you go by the same logic of target by acquirer, the ratio comes to 5:1. That means their 1 share is worth 5 shares of our company, which is totally wrong. It's opposite. It's exactly opposite. You are not going to give them your 5 shares, which is only giving 10 rupees of the loss per share for 1 rupees of their share, 1 share of their company. You are in a better situation. Your share loss per share is low. Your loss per share is low, sir. So what will be the exchange ratio? It will be acquirer by target, that's 10 by 50. That means you will give only 0.20 share as against 1 share of their company because of this situation. So negative factor, in negative factor, this will be the formula, acquirer by target. Okay, sir. That's very much clear. Now coming over to the next part. Let's say, for example, we can solve the second question itself now. Yeah, that's it. So this is the exchange ratio. This is the exchange ratio based on which you will decide how many shares should be given to the other company. We'll take the rest of the part from this along with the question itself. Have a look on the next question. So question number 2 is homework for you. Question number 2 and question number 3 is quite similar. I will directly take question number 4, which is exactly equal to 2 and 3 as well. So don't worry about it. Once you go through question number 4, you can solve question number 2 and 3 as well. Have a look. A Limited, a listed company, is considering merger of B Limited, which is also a listed company, with itself by means of a stock swap. See, Here they are not saying that we are going to give them cash. They are not giving cash to buy the company. They are going by way of a shares. There were two methods. Cash is to share. That was question number 1. And this is question number 4. Share is to share. We bought shares of the other company in question number 1 as against cash. But now we are giving them shares as against share. So this share will be of acquirer for target. Okay. B Limited has agreed to a plan under which A Limited will offer the current market value of B Limited shares. What does that mean? It means that whatever the market price of your share is, we are going to pay that to you. But not in terms of cash, in terms of shares. So have a look. Earnings after taxes of both the companies is 10 lakh and 2,50,000. And you can see, if you acquire B Limited, the merged entity, let's say merged entity A Limited, the earnings after tax of the merged entity will be 12,50,000. If there is no synergy benefit, we will talk about it later on. Number of shares outstanding, 4 lakh and 2 lakh. Current market price is 50 and 20. See, we as an A Limited are ready to pay 20 rupees to them for buying their 2 lakh shares. So think it like that. You are buying 2 lakh shares of B Limited at 20 rupees. So that comes to 40 lakhs, right? That comes to 40 lakhs. But you are not giving them 40 lakh rupees of cash. You are giving them the shares of A Limited itself, your shares, A Limited shares, and which is worth 50 rupees. So if you give them one share, that means it is equivalent to paying 50 rupees, right? So 50 rupees is the price of your shares. So 40 lakh rupees of the purchase consideration will be distributed, or we can say resolved by paying or giving one share or every shares of A Limited, which is at 50 rupees. So 40 lakhs divided by 50 will give you 80,000. So 80,000 of A Limited shares has to be issued in order to buy 2 lakh shares. And the exchange ratio is very simple. You don't have to do so much of the calculation. You just have to make sure that you calculate the exchange ratio. And if this is on the market price, which is higher the better, this market price is a positive factor, the formula is target by acquirer. That's what we discussed. And the target by acquirer is 20 by 50. That's around 40%. 0.4:1 is the ratio. That means for every 1 share of B Limited, 0.4 shares of A Limited will be distributed. So when you multiply 0.4 with 2 lakh, that means 80,000 shares will be given to them. Now try to understand. This A Limited already has 4 lakh shares with them in the balance sheet. They will have to issue 80,000 additional share. So after merger, the total number of share will be 4,80,000. Am I right? After merger, the total number of share of A Limited will be 4 lakh and the new shares that has been issued. Please don't try to confuse yourself that 4 lakh plus 2 lakh will be the shares of A Limited. No sir, 2 lakh is the shares of B Limited. Once you merge this B Limited, this company will cease to exist. We will close this company. That means close all the shares of 2 lakh number. Those shares will get destroyed, 2 lakh shares. And in addition, in replacement of that, you will issue 80,000 to the shareholders. So 4,80,000 will be the new shares of A Limited after merger. What will you achieve with this? This is a post-merger earning. This is post-merger number of share. If you divide the post-merger earning with post-merger number of share, you will get post-merger EPS. That's 2.604. Am I right? Have a look on rest of the question now. On the basis of above information, you are required to calculate the following. What is the pre-merger EPS and P ratio of both the companies? It's very simple, sir. How do you calculate pre-merger EPS? Just a second. So this is the data given to you, or I will just do it with the red mark, red color. Earning after taxes divided by number of shares will give you EPS. So 10 lakh divided by 4, that means A and B. EPS 2.5, and in the other case 2,50,000 divided by 2 lakh, that is 1.25. This is the pre-merger EPS. EPS before merger. The market price of both the companies 50 and 20, and with the help of that, can you calculate PE ratio? Market price divided by EPS. So 50 divided by 2.5 comes to 20, and 20 divided by 1.25 comes to 16. So this is the PE ratio, this is the EPS. Try to understand. PE ratio of A Limited is higher, which is wrong. Higher PE ratio is not a good idea. Okay. That what does that mean? 1 rupee of earning requires 20 rupee of investment in A Limited, whereas 1 rupee of earning requires 16 rupees of investment in B Limited. So that these are the two answers to you: pre-merger EPS and PE ratio. See. Earning after taxes divided by number of share of both the companies will give you EPS. And then EPS and market price combined with each other will give you PE ratio. Let me just try to close it once and open it again. Have a look. We'll start again. This is earning after taxes divided by number of shares. So you got EPS, and market price divided you got PE ratio. That's okay. That's the first answer. Let me just discuss about the second part. If B Limited, this is the target company's PE ratio is 10. So what they are saying is, instead of 16, assume it as 10. Okay, not an issue. What is its current market price per share? If we assume the PE ratio of B Limited as 10 and then we multiply it with the EPS, can I say the market price will be 12.50? Instead of 20, it will be 12.50, because they are saying that assume the PE ratio as 10. So if we assume the PE ratio as 10, multiply it with the EPS, the market price will be 12.50. Also, what is the exchange ratio? What will be A Limited's post-merger EPS? Now, what exactly we have to calculate? Forget about what I said in the previous part of this question itself. If you go with the market price, it is clearly written here that you consider the new market price, which is 12.50 rupees, and then calculate the exchange ratio. Exchange ratio based on the market price is target by acquirer. Now, our market price is 50, and their market price is 12.5. So the new exchange ratio will be 12.5 divided by 50. See, 12.5 is to 50. That means 0.25 shares for every 1 share of B Limited. Or you can say, if you multiply it with 4, 1 share of A Limited for every 4 shares of B Limited. That's the new exchange ratio. Again, they are saying what will be A Limited's post-merger EPS. Now, try to understand this. In order to calculate post-merger EPS, you need to take post-merger earnings of A Limited and post-merger number of shares. So the earnings of both the companies is 10 and 2.5. That's 12.5 lakh. Let me just write down here, 12,50,000. And what will be the number of shares? See, for every share of B Limited, you are giving them only 0.25. So either you can divide by 4 or multiply it with 0.25. So 0.25. So can I say only 50,000 shares are being issued by us to the shareholders of B Limited? So 4 lakh shares were already outstanding in our company. We have issued 50,000 more shares of our company. So the total has gone to 4,50,000 number of shares. So 12,50,000 divided by 4,50,000, I think, is 2.78. This is the post merger EPS. That's what the question is asking. What will be the post merger EPS? Post merger earning, total of both, post merger number of share. It is not to be taken as total of both, right? 4,50,000 and then 2.78. Have a look. 10 plus 2.5, 4 plus 50. This 50,000 is arrived at after multiplying or dividing 2 lakh with 4. That 4. Do you understand this? Now coming over to what must be the exchange ratio? What must the exchange ratio be for A Limited's pre-merger and post-merger EPS to be same? What do you think? See, you can clearly see A Limited's EPS was 2.5, right? And in this case of previous question, the EPS has changed to 2.78. We have to calculate an exchange ratio in such a manner the EPS of pre-merger should be same as post-merger. That means we want to keep, understand, we want to keep the EPS after merger as 2.5, right? 2.5. That means EPS has to be kept same. And if the EPS has to be same, the exchange ratio basis should also be EPS. Whatever you want to keep same after the merger, take that itself as a basis of exchange ratio. So if we take EPS as the basis of exchange ratio, 1.25 divided by 2.5 will be the exchange ratio. So exchange ratio will be 0.5:1, or you can say 1:2. Give them half of the shares. Half of the shares. For every share of their company, give them half of your company shares. So in place of 2 lakh shares, give them 1 lakh shares of your company. You already have 4 lakh shares. 1 more lakh will add up to 5 lakh. So 12.5 lakhs divided by 5 lakh shares will give you exactly this much of the EPS. Calculation of exchange ratio of A Limited's pre-merger and post-merger EPS to be same. Total earning pre-merger, this is 12,50,000, 2.5. Have a look. We want to keep this as same as the post-merger. Total earning is 12,50,000. If you divide this by EPS, the post-merger number of share should be 5 lakh. Existing shares is already 4 lakh. That means 1 lakh shares is additional that you can issue to them for 2 lakh shares. So what is the exchange ratio? 0.5:1, or you can say 1:2. And that can be easily calculated. Instead of doing all this calculation, if you take the EPS as exchange ratio, target by acquirer, 1.25 divided by 2.5, this will also give you same exchange ratio. So you go it by this way or that way. Simple. Now the number of shares that can be issued to B Limited is 1 lakh as against 2 lakh. So 1:2. It means for every 2 shares in B Limited, 1 shares of A Limited should be given. Alternative. I will just give you another method. If EPS has to be same, then basis of exchange ratio should also be EPS. Target by acquirer, 1.25 by 2.5, that's 1:2, or you can say 0.5:1. That will also do the work. If you want to keep the EPS same post merger as well, Okay, sir. More questions are waiting us. Question number 5 now. Have a look. So B Limited is highly successful company and wishes to expand by acquiring other firms. Okay. Its expected high growth in earnings and dividend is reflected in its P ratio of 17. Okay, so what we should do, I think, is question number 5. B Limited P ratio 17. Now, the board of director of B Limited has been advised that if it were to take over firms with a lower PE ratio than its own using a share for share exchange, then it could increase its reported earnings. The board of directors are saying that buy the companies with a low PE ratio in order to increase the reported earnings per share. C Limited has been suggested as a possible target for takeover. So C Limited is what we are going to buy now. Okay. Which has a PE ratio of 10, 1 lakh shares and the issue price of 15. See. 10, number of share and market price. So 1 lakh shares and market price of how much? 15. Whereas this company, the B Limited that we are talking about, the acquirer, has 5 lakh shares and the issue price of 12. So it's 5 lakh shares and issue price of 12. Now it is very much clear to you that entire paragraph. Most of the time, if you ever come across a paragraph now, instead of a table, if the paragraph has values, first thing that you should do is convert that into a simple table or simple data. This is what the question is asking. Rest everything else is just a theory. Okay. Calculate the change in EPS per share, earning per share of B Limited if it acquires the whole of C Limited by issuing share at its market price of 12 rupees. So market price is the basis of exchange ratio, right? Assume the price of B Limited shares remains constant. And it's very much simple. You are giving them your shares of 12 rupees. So practically speaking, if you want to calculate, it's very easy, sir. You first, I will just do the rough working. This is the total value of their company. Am I right? 15 lakh. Okay. And are you going to give them cash? No, you are giving them your own share, which is worth 12 rupees. So how many shares you have to issue for your own company? That's 1,25,000. What is the another method of calculating this 1,25,000? First, you calculate the exchange ratio as 15 by 12. Market price is the basis. And if market price is the basis, target by acquirer will be the formula. So that comes to 15 by 12, that is 1.25 shares of your company for 1 share of their company, and their company shares has 1 lakh. How many shares you are going to issue? 1 lakh into 1.25, that comes to 1,25,000. Okay, now this much of the additional shares you will issue. That's cool. With the help of the given data, you can calculate certain like few more data. First of all, calculate EPS. EPS is nothing but market price divided by P ratio. 12 divided by 17. Okay, that's, or we can easily calculate the earnings. Market price divided by P ratio can also be 5 lakh into 12 divided by 17. That comes to 350 to 942. That's okay. Let's calculate the EPS. EPS will be 12 by 17, and in this case it will be 15 by 10. 0.7059 1.5. Number of shares 5 lakh and 1 lakh. So this is the total earning after tax. Am I right? 352 950 and 1,50,000. So try to understand now. We have to calculate the post-merger earning per share. The question is clearly saying what is the change in the EPS. Right now the EPS is 0.7059 and we have to calculate post-merger earning per share, and then we can compare both of them to calculate the change. So total earnings is 352,950 plus 1,50,000. Total number of shares, we already have 5 lakh shares, plus we will be issuing 1,25,000 more shares. Am I right? So 352 502,950 and 6,25,000. Post merger. So this will be your post merger EPS. That's 0.8047. What was the pre-merger EPS? 0.7059. Am I right? So this is going to be the change, the difference between these two. Let's come to the answer now, one by one. Total market value of C Limited 1 lakh into 15, that's 15 lakh. P ratio is 10. That means total earning is 1,50,000. That means they have calculated through like this and that. Ultimately the answer is same. See, our answer is 0.7059 in 4 decimals, 0.8047. They have 0.7059 instead of 0.7059. They have rounded it off to 0.71, and this is the new firm's EPS, that is 0.80. You can clearly see 352 is the earning after taxes of the pre-merger company. This is 1,50,000 the other company. This is the total earning after merger. Total number of shares 5 lakh plus 1,25,000, that's 6,25,000. So this is how they have calculated. 15 lakh total market value, then divided by PE ratio, you will get the earning per share, total earnings. So you can do it like this as well. Market price divided by PE ratio into number of share, that will still give you 1,50,000. So we did it this way, they did it this way. I told you in the very beginning that you can approach like this also, like this also. There are multiple ways to calculate the same thing. Total market value of B Limited. Total market value of B Limited is 60 lakh rupees. PE ratio is 17. Therefore earnings. So this was for C Limited. This is for B Limited. So instead of this also we can do it like market price by EPS into market price by PE ratio into number of share. Then it would have given us 352,941. So this is the earning of target company. This is our earning. If we do the total of it, it will come to this much. Okay. After that, how many number of shares are to be issued? We have to pay them 15 lakh rupees, their market value at our price, which is 12. That's 1,25,000. What was the other method of calculating this 1,25,000? Calculate the exchange ratio first as the market price of target company, which is 15, and our company. So that was 1.25 per share. How many shares do they have? 1 lakh. So 1,25,000. So there are two ways to calculate this 1,25,000. So we will issue this much of the share. Already we are having 5 lakh shares. We are going to issue 1,25,000 shares. The total will be 6,25,000. So total EPS and the number of share, you get the post-merger earning per share. And pre-merger earning per share of the acquirer is the earnings divided by earning, pre-merger earning divided by pre-merger number of share, 5 lakh, that's 0.71. And the total, the difference between these two is the change. So we can clearly see the EPS of a firm B will increase from 71 to 80 as a result of the merger. That's it. What is the change? This is the change, sir. Let's come to the next question now. Okay, have a look. This is another question. Mostly we are going to repeat like half of the answer. You are going to feel like, okay, this has been done in the previous question as well. Company X. Company X is contemplating the purchase of company Y. Company X has 3 lakhs shares having a market value of 30 rupees per share, while company Y has 2 lakh shares selling at 20 rupees per share. The very first thing that you should do all the time whenever the data is given in your paragraph, company X, company Y, like this, and 3 lakh 30, 2 lakh 20. So this is number, market price, EPS, 3 lakh, 2 lakh, 30, 20, and the EPS is also given as 4 and 2.25. So 4 and 2.25. Cool. What else? Management of both the companies are discussing 2 alternative proposal for exchange of share. Now in this question, there is no single basis of exchange. There are 2 different bases. So how to exchange the shares in proportion to relative EPS of the 2 companies, or a customized version, 0.5 shares of X for 1 share of Y. That is 0.5:1. Now what you are required to do to calculate EPS after merger under both the alternatives, and also show the impact on EPS of shareholders of the 2 companies under both the alternatives. So we'll take one by one and then we will solve it. Let's take first basis as EPS. I will just show you first basis as EPS. So the very first thing to calculate is what will be the exchange ratio. EPS is a positive factor, higher the better. So what will be the formula? Target by acquirer, that is 2.25 divided by 4. 2.25 divided by 4 is 0.5625 shares of our company X for every share of Y. Y has 2 lakh shares, you can clearly see. For every share we are going to pay 0.5625 of our company. So how many shares we are going to issue? Number of shares to be issued, 2 lakh into 0.5625. Am I right? So you are supposed to issue 1,12,500 shares. Now, what are the existing number of shares in our company? It's already 3 lakh. So the total number of share after merger will be 4,12,500. What do we have to calculate? Post merger EPS. It's nothing but post merger earning after taxes divided by post merger number of share. Am I right? So if you do the calculation, what is the earning after taxes? See, it has not been given here, but you can calculate it easily. Just write down one more row and multiply the number of share with EPS. 3 lakh multiplied by 4, 12 lakh rupees. 2 lakh multiplied by 2.25, 4 lakh 50,000. So can I say the total earning after taxes is 16 lakh 50,000 after merger? Also, total number of share 4,12,500 and the EPS will be 4. EPS will remain same. You can clearly see why it is same as pre-merger and post-merger, because the basis of exchange itself was EPS. When you take that basis, you make sure that the pre-merger and post-merger value of that basis will remain same. We have done this question in the past and it is same. If we want to keep the earnings of both the shareholders same, in this question also you can see in this part, the pre-merger company was X, that X Limited was the acquirer, and the shareholders of that company were earning 4 rupees per share, pre-merger also and post-merger also. But I will tell you one more thing. Y Limited's shareholder are also earning the same amount, 2.25. I will tell you how. Y Limited's shareholders before merger were earning 2.25 on every share, but under post merger they only have 0.5625 share as against 1, only this much, and every share is worth 4 rupees of EPS. So how much they are earning on that share? For 2.25. So the earnings to them have not decreased. It's the same because you have kept the basis as same. So if the question asks you that what should we do in order to maintain the post-merger and pre-merger earnings of the target company's shareholder to be same, and the only answer is keep the exchange ratio basis as EPS itself. If you want to keep the EPS as same, keep the basis as EPS. Okay. If we do the same calculation for the second part of this question, I will just try to change few things here so that you can compare. The second part says that simply the exchange ratio has to be 0.5:1, right? So how many number of shares you will issue? Instead of 0.5625, you will issue 1 lakh shares. Am I right? 2 lakh into 0.5, because that's the exchange ratio, 1 lakh. Existing shares are 3 lakh. You will issue 1 more lakh. The total number of share will be 4 lakh. So what will be the post-merger earning per share? It will be 16 lakh 50,000 divided by 4 lakh. And that's 4.125. This is the new post-merger EPS. That's it. That's what you have to change. Have a look. See, I told you that it is the same, 4 into 0.5625 for both the shareholders. The EPS is same. So what is the impact of EPS of the shareholders of both the companies? When the basis was EPS now, there is no impact on the EPS on the shareholders of both the companies. Before merger 4, after merger 4, 0 impact. Before merger 2.25, after merger also 2.25, no impact. But if you change the basis, have a look. If you change the basis, the new EPS is coming to 4.125 as like this. So now the impact. Before merger, company X and company Y. This is the acquirer. This is the shareholder of target company. Let's talk about acquirer. Before merger, acquirer's share earning per share was 4. Now it is 4.125. 1:1 share. So the gain to them is 0.125 on every share. They are very happy with the merger because their EPS has increased. But these people, the shareholders of company Y, are at loss because one share of their, one share of their pre-merger company used to give them 2.25 rupees, but they got only 0.5 shares in the post-merger company as against 1, and 4.125 is the EPS of 1 share. Earning per share is the earning of 1 share, but they only have 0.5. So 4.5. That's 4.125, sorry. What does that mean? If a shareholder was holding 1 share in the pre-merger company, is now holding only 0.5 share in the post-merger company. He was earning 2.25 previously. Now he is holding only 0.5 shares. So how much he is earning? 4 point. How much he is earning now? He is only earning 2.0625 as against 2.25 previously. So there is a loss of 0.1875. That's a loss to him because he got less number of share. This is called as equivalent EPS. When you multiply the EPS with the exchange ratio after merger, that will give you the equivalent earning per share. That means how much a shareholder holding one share previously is earning after the merger. This much. Practically speaking, obviously you won't be holding 0.5. Instead of 2, you can compare it with 1. You will still get the loss. That will double. Okay, sir. That's the question. Okay. Question number 7 is going to be our next question. Let's have a look. P Limited is considering takeover of R Limited. Who is the acquirer here? P Limited. Who is the target company? R Limited. By the exchange of 4 new shares in P Limited for every 5 shares. What is the exchange ratio, my friends? 4:5. This is the exchange ratio. For every 5 shares of their company, we are going to issue 4 shares of our company. The relevant financial details of the two companies are as below. Profit before tax and the tax rate is given to you. You can simply calculate profit before tax, then profit after tax, then divided by number of shares, then you will get EPS, and the P ratio is also given. P ratio, then you will get the market price. When you multiply it with number of share, you will get the market value. Can you do that? It's very easy. You just have to take the values and keep on doing it. Who knows this? Whosoever knows this thing now, this particular format of calculating everything, it's very easy for him. So you will take the profit before tax, deduct the taxes, profit after tax divided by number of share, EPS multiplied by P ratio, and you will get the market value of both the companies. Okay, sir. Have a look. We have to calculate the market value of both the companies, right? You can calculate it in a straight table. Instead, like institute started with the proper answer, profit before tax, profit after tax, then earning per share, and then instead of that directly we can write down P ratio column, then market price, and then market value. So instead of separately taking the market value here, you can calculate in the respective tables. Okay, so what is the market value? 5.04 is the price of both the share, 5.04, 5.67. This is the number of share, and the market value is like this. Combined market value is 211.05 crores. That's it. Now, what is the value of original shareholders in the combined value? I will tell you. How many number of shares are there for R Limited? You can clearly see R Limited is having 15 crore shares, right? So 25 and 15. Try to understand. We are giving them 4:5 ratio multiplied by 15. So how many shares we are going to issue to them? Only 12 crore. Earlier we had 25 crore shares. Now 12 crore shares of our company will be issued to them. So the total number of shares will be, we can take it here. Total number of shares will be 37 crore after the merger. Okay, 37 crore. That means R Limited is holding 12 by 37, P Limited is holding 25 by 37. If you want to calculate the percentage, you can do that. So this is the holding of both the shareholders. Question is asking you the same. What is the value of original shareholders in the combined value? Combined value is 211.05 crore. This is the combined value of all the 37 crore shares. So if you want to calculate for the acquirer and target, you can do it like this. 25 by 37 into 211.05 or 12 by 37 into 211.05. What are you doing with this? You are distributing the market value in both the shareholders in their holding ratio. That's it. That will change obviously, because now they do not hold 15 crore shares in the post merger company. They only hold 12 crore shares. So 25 by 37 comes to 67.57%. See, 25 by 37 comes to this much of the percent, 12 by 37 comes to this much of the percent. So what is happening? This price into this percentage, this is the value of P Limited shareholders in a combined market or a merged value, 142.61. So this is 142.61 here. And if you go with R Limited, they are only getting 68.44. 68.44. That is lesser than what they had before. That's the value. This is the pre-merger value. This is the holding in the combined value. Holding of each of the shareholders in the combined value. That's it. Value of the original shareholders. Now comes the price per share after merger. How to calculate the price per share after merger? Do not take this as the post merger market value. You have to calculate it. Very simple, sir. Question is asking you about the post merger market price after the share. Market price is equal to EPS into PE ratio. So what are we going to do? There is a general assumption that we are going to keep this PE ratio constant after the merger as well of acquirer, because after merger acquirer company will continue. So we will assume that the acquirer's PE ratio will also continue. In order to calculate this price as post merger, we need this earning per share also as post merger. And how do we do that? We will total both the earning of both the companies. That will come to 10.50 plus 9.45. That's 19.95. And then divided by 37 crore shares. Right? Post merger, the number of shares will be 37 crore. Now we will get the earning per share, which comes to 0.5392. So this is the new EPS, and we are assuming that the PE ratio will remain same as 12. So when you multiply it, the answer is 6.47. That's the post merger market price of the merged entity. Have a look. See, total earning divided by 37 crore. This is the EPS, post merger EPS, PE ratio, EPS into this. The story is over. 6.47. Okay. Effect on share price of both the company if the directors of P Limited expect their pre-merger PE ratio to be applied to the combined earning. That's what we did in this part. We applied the pre-merger PE ratio on the combined earnings, that is EPS. See, the combined earning is 0.5392 per share or 19.95 total. Simple. Okay. So we have to calculate the effect. Effect means what happened to this prices 5.04 and 5.67. It's very simple, sir. Understand. 5.04, 5.67. This is acquirer, this is target. Try to understand. Now the market price of the merged entity is 6.47. So for acquirer, it's very simple. They had one share worth 5.04 earlier. Now they have the same share, but the market price of that share has increased. So there is a gain to them of 1.43 rupees. But in T Limited, it is not the case. It's not that simple. T Limited had one share worth 5.67, but instead of one share, they only received 0.80 in the post-merger company. I will tell you, 1 into 4 by 5, that was the exchange ratio. So 1 into 4 by 5, that goes to 0.80. That means if you want to calculate one share, or like share by share, they only received 0.80 in the post-merger company. And every share in the post-merger company is worth 6.47 in terms of market price. So what is the market price of this person? 5.176. This is called as equivalent market price, which is very simple. Market price post merger into exchange ratio. So anyone who was holding 1 share earlier is now holding only 0.80 share. So only to that extent the market price should be compared. And that's a loss to this guy, 5.67 minus 5.176, a loss of 0.494. Question asked us about the effect on the market price. This is the effect on the market price. Acquirer is on a positive or a better side because they are gaining in terms of market price, increase in the market price, but the target company shareholders are losing. 1.43 and minus 0.49. See, 1.43 and minus 0.49. That's what they are doing. You can calculate it in terms of percentage if you want. Otherwise, 1.43 and 0.49 negative is also correct answer. Question is only asking you about the effect, not calculating the percentage. So that's the end of the story. This is an easy question. I will just leave it to you. Homework, question number 8. Yeah, question number 9 is what I think interesting one. Let's have a look. Okay. So B Limited wants to acquire S Limited. Okay. B Limited is our acquirer company. It's an easy question, not that difficult one. Just a second. So this is an acquirer company and this is target company, and the swap ratio that has been agreed is 2:3. That means for every 3 shares of S Limited, B Limited's 2 share will be offered to them. Profit after tax divided by equity shares, EPS multiplied by PE ratio, you will get the price easily. Okay. So everything is given in sequence. 21 lakh divided by 6 is EPS 3.5 multiplied by 10 PE ratio is 35 rupees market price. Same is with the S Limited. Now, the number of equity shares to be issued by B Limited for acquisition of S Limited. How many shares will be issued? It is in the ratio of 2:3. So multiply the number of share into 2/3. That will be 1,20,000. Am I right? So what will be the total number of share after merger? 6 lakhs and 1,20,000. That will be 7,20,000. What is the total earning after merger? 21 and 4,50,000. That's 25,50,000. Am I right? So can we calculate the post merger EPS? 7,20,000. That comes to 3.542. If we keep the PE ratio of acquirer constant, the market price will be 35.42. Right? Acha, one more thing. Chalo, let's see what the question is asking us. What is the EPS after acquisition? That's 3.54. That we just calculated, 1,20,000. Total earning, total shares, 3.54. Another thing, determine the equivalent EPS for S Limited. See, S Limited had different EPS and he received different number of shares as well. Earlier he had EPS of 2.5 for 1 share, but now he has received only 2/3. 1 into 2/3. If you do it like this, that's 0.67. Now he has received only 0.67 shares. So 0.67 into this much of the earning will be equivalent EPS. I will just tell you. This is the difficult part, right? 1 into 2.5 was my earning before merger, right? But in place of this, I only received 0.67 shares. I want to compare this earning with this earning, na? So I need to make sure that how many shares has been received by a person who was holding 1 share earlier. He got only 0.67, that is 2/3. and every EPS is having 3.54 as the earnings. So what is the equivalent earning now? It's only 2.37. So he is actually losing on by 13 paisa. Earlier his earning was 2.5, now it is 2.37 only. Have a look. 13-14 paisa. So equivalent EPS is 3.54 into 2 by 3. The number of share that he is holding in the post merger company. So now his earning is 2.36. Earlier it was 2.5. He is losing 14 paisa on it. Okay, one more thing. What is the market price per share after acquisition assuming PE multiple remains unchanged? It's very simple, sir. If you do not change the PE ratio, then EPS after acquisition multiplied by the PE ratio. It was 10. 3.54. I told you it is 35.40. After the merger, the market price of B Limited will go to 35.40. Very simple till this point. Now determine the market value of the merged firm. Market price of the merged firm that you have calculated 35.40 multiplied by the post merger number of share. How much is the total number of shares, sir? Post merger number of share, that is 6 lakhs and 1,20,000. 7,20,000 into per share price. This is the market value of the company. It's very simple. The best part of this question, because of which I took this, because all these are repeated one, is this sixth part. Understand this. After the announcement of merger, the price of shares of S Limited, this is the target company, and the price was 17 rupees 50, 17.50 rupees before merger. Because of this announcement of merger, the price of this share rose by 10% on the stock exchange. That means if you will add 10% to it, now your share is worth 19.25 rupees. Okay. Mr. X, an investor having 10,000 shares of S Limited, is having another investment opportunity. Can you imagine? Mr. X, whose share price was 17.50 before this announcement, is now 19.25. If he wants, he can sell all the 10,000 share in the market at 19.25. Okay. But he has another investment opportunity which yields annual return of 14%, is seeking your advice whether he needs to offload, that means sell the shares in the market, or accept the shares from B Limited. So there are two options with this shareholder. I will just show you. He has 10,000 shares of 19.25 now. Okay. So his portfolio value is 1,92,500. Now he has two options: sell those shares in the market, receive 1,92,400, invest in the opportunity that you have, and you can earn 14% on that. But the second option to him is accept the shares from B Limited, where you are not going to get any rupees. Your entire 10,000 shares of S Limited will be converted into 10,000 into 2 by 3. That is 6,600 and something shares, right? So you will become the shareholder of B Limited now, where your earning will be your equivalent EPS, right? You are not getting exactly same EPS in this company. So the earning in this company, or being the shareholder of B Limited, you are going to earn this much equivalent EPS, which is 2.36. Am I right? Your earning in this company, what this company is giving you, the new company in which you will be a shareholder, it will give you the EPS 2.36. So for you, from your point of view, you are giving up your 19.25 rupees of one share for the earning of 2.36. So practically speaking, if we want to calculate 2.36 divided by 19.25, the rate of return in this company is only 12.26%. Don't you think the investment, practically speaking, if you accept the shares from B Limited, you will say that this is my investment now, 1,92,500. If I give it here, I'm only getting 2.36 per share, right? 90 on 19.25, not per share, but on 19.25, I'm getting this much equivalent EPS. So the return on investment is 12.26% here, but the same amount of 1,92,500 can be invested somewhere else where you have the opportunity of 14%. So what's your decision? My decision is to sell the shares in the market. Don't accept the offer of B Limited, because B Limited is not giving me proper return, or at least a return where I can get more than 14%. No. So investment opportunity of this should be accepted. 12.26 is a lower return. Have a look. 2.36 divided by 19.25, this is 12.26% that you are going to earn. As Mr. X is having another opportunity to earn 14% and the expected return of S Limited is only 12.26%, it is advisable to offload in the market. That means sell your shares in the market immediately, receive 1,95,000 rupees, invest somewhere where you are getting 14%. That's the answer. Very easy. And actually this is related to the practical world. This is more of a practical question than theoretical. Cool. I'm giving you this question as an homework because see, you have been given with again there will be two companies, acquirer and the target company. Earning after taxes divided by number of share will give you EPS, multiplied with the P ratio will give you market price. Cool. What is the swap ratio based on the current market prices? On this market price that you are going to calculate, you will calculate the swap ratio. Swap ratio is nothing but the exchange ratio. Because market price is a positive factor, target by acquirer will be the formula. What is the PES after P ratio after what is the EPS after acquisition? It's very simple. Add both the profits. It will be 6,000 divided by the post merger number of share. Existing number of share is 200, plus you are going to issue them on the basis of this exchange ratio. So that will add up to that. You will get the number of share and post merger EPS. Since this is the post merger EPS and you want to keep what is the expected market price per share of Money Limited after acquisition, it's very simple. Post merger market price is equal to post merger EPS that you calculated in the second part into P ratio. Now understand, assuming its P ratio is adversely affected by 10%. P ratio is adversely affected by 10%. I will just show you. So these are the market prices. 20 by 100.20 is the swap ratio. So let me just take it from here. If you multiply it with 0.20, the number of share that you are going to issue is again 200. 200 is already is what you are having. 200 is new shares that you are going to issue. So 6,000 by 400 will be your new EPS. That's 15. Okay. Now this 15 will be multiplied by the P ratio. 0.9. Understand, it is EPS is 15. Now I'm quite we can say not satisfied with the P ratio that they have calculated. When you say adverse in terms of P ratio lower is the better, higher is not the better, not good. So adverse situation in P ratio is when the P ratio increases, not when it is decreases. But I will take that as institute wanted to, or this question wanted to say that the P ratio will decrease by 10%. In this part you can consider the adverse as decrease. Institute might have wanted to say that it is a decrease in the P ratio. So 10 is the current P ratio, less 10%, 9. Post merger EPS is 15, multiplied by P ratio, you will get the post merger market price. Once this post merger market price is calculated, multiply it with the number of share post merger, that is 200 of your existing and the 200 of the new shares. You will get the market value. And then the gain or loss is very simple. Sir, Money Limited, Ratnan Limited, total value before acquisition. See, I will show you. How many number of shares they are holding? 200 and 1000, right? What is the question first? Calculate the gain or loss to the shareholders of the two independent entities due to merger. How much both the shareholders have gained or lost? So it's a very simple thing. What was the market value of both before merger and after merger? Before merger, the total number of shares were 2000 and 1000. Market price was 120. The total market value was 20,000 here and 20,000 here. So that's the 20,000 market value. Now in terms of lakhs, now this is pre-merger. What is the post-merger market value, sir? So they have written in terms of crores, so that's why 200 and 200 instead of 20,000. Now 54 lakhs, if you take it in lakhs, is the total market value, out of which how many shares are held by Money Limited? 200. How many by Ratnam? 200. Equal. So divide that equally. 270, 270. 27,000, 27,000. Simple. So earlier their value of before acquisition, the value was 20,000 lakhs. Now it is to 27,000 lakhs. Both of them are gaining 70,000 lakhs in terms of market value. So number of share, you will divide it by the number of share that they were holding. So this is the gain per share in terms of the pre-merger numbers. Even if you close the question here, that's okay. 70 lakhs. This is the pre-merger market value. This is the post-merger market value. Since this was easy because both the shareholders were holding equal shares in the post-merger. So we divided equally this 54,000 lakhs. Cool. See, EPS subsequent to merger. You take the earning after taxes, you take the number of share. That's it. What is the change in the EPS? What is the market value post-merger? If the PE ratio is likely to be same, this is the PE ratio that you are going to keep the same. So earning after taxes divided by equity, you will get the EPS multiplied by PE ratio, you will get the market price. It is just like the question number 9 that we solved. Company Rama Limited is acquiring the company Krishna Limited. This is very, focus on this. What is the trick in this question? The second company is acquirer and this is target company. So we form a habit by solving this much of the questions. We thought that the first company given is always acquirer, but in this question, Rama Limited is acquiring the company Krishna Limited. It's opposite. Exchanging its shares on a one-to-one basis. This is very easy for us to calculate now. One-to-one basis means what? Acha. Exchange ratio is based on the market price of the shares of two companies. See, market price is same of both the companies. So one share for every share. What is the total profit after tax? 17 lakhs. What is the number of share? 6 lakhs. Because we are offering one share for every share that they are holding. There is a correction. Instead of rupees, it will be numbers. It's not rupees. So can we calculate the EPS? Yes, sir. 17 lakh divided by 6 lakhs. The EPS is 2.83. And if we keep the PE ratio same, the market price will be 28.30. Simple. Okay. What the question is asking is, what will be the EPS subsequent to the merger? 2.83. Am I right? What is the change in the EPS of the shareholder? It's very simple, sir. They had 3.5 earning pre-merger. Now it is 2.83. It's a loss to the Krishna Limited. Krishna Limited is the target company, man. Target company. So they are losing. But the acquirer 2.5 to 2.83, they are gaining. Okay, sir. Determine the market value of the post-merger firm if the PE ratio is likely to continue. See, if the PE ratio is likely to continue, this pre-merger, post-merger EPS will be converted into market price and then the number of shares 6 lakhs. So 28.30, you can see 28.30 into 6 lakhs. That's the market value. Have a look. 2.83. Then what is the new market price? Oh, that's my mistake. See, I did the same mistake. Question is saying that the acquirer's P ratio will continue. So acquirer is Rama Limited, right? Not Krishna. So 14 will be the P ratio that will continue. And accordingly, we will change the market price. 2.83 into 14, the market price will be 39.62. That's what the mistake was. So please learn from this mistake. It's very much important. So 2.83, now you can see the gain and loss, increase in EPS and decrease in EPS as compared to the previous EPS. So this is gain or loss to both the companies. Krishna losing, this is target, and acquirer is gaining. Now P ratio is 14 times. The new market price will be 39.6. The number of share is equal 6 lakhs, and this is the market capitalization post merger. Pre-merger market capitalization of both the companies was 2 crore 10 lakhs. Now it is 237. So entirely, if you speak, the total gain is this much. What is the last part? Ascertain the profit accruing to the shareholders of both the companies. Is it easy? Yes, sir. What is the market value before merger and market value after merger? That's it. You have to do it like that. See, in the fifth part, see, number of shares, market price. This was the certain corrections are there. Instead of this, we will take the correct market price, which is 35. 35 was the market price instead of. So I will take 35 here and 35 here. When you multiply 4 lakh with 35, you get. Achha, let me just check once again. No, it's correct. That's my bad. The table is correct. I thought this is pre-merger values, but it's correct. This is the number of shares after merger. This is market price after merger. So this is the market value after merger. Okay, this is the market value of each of the shareholder after merger. So what we did is we divided this 2 crore 37 lakhs into two parties, the shareholders of Rama, the shareholders of Krishna, and we took the existing market values. How do you calculate the existing market values? Multiply 4 lakh with 35 and 2 lakh with 35. The 35 was the previous pre-merger market price. So multiply the number of share with the pre-merger market price to get the existing market value, and that will give you the gain. You can clearly see the Rama Limited, who is the acquirer, is gaining by 18,48,000. Am I right? Yes. And the Krishna Limited is also gaining in terms of market value, 79 lakh to 70. From 70 lakhs to 79 lakh has become the market value. So 9,24,000. So we can say that although Krishna Limited is losing in terms of EPS, but they are gaining in terms of the total market value. So that's a good news for them, and they can get convinced for the mergers as well. That's cool. Okay, sir. Now the next question, again the swap ratio, number of share, new EPS, market price, and market price if the P ratio declined to 12. All are like everything has been covered by us. How do you calculate the swap ratio on the basis of market price? Then one by one, every other question is linked to the previous one. So try this at home. Homework. Let me check this one. Yeah, question number 13. We'll take this question number 13 after the break. For this part, this much is enough. In the next lecture, we are going to start with the question number 13, which says about true cost of merger. Let me just go through what we have done till now. So if we come in the concept part, you can clearly see that the true cost of merger starts from the 11th part, right? So this was the first phase that I was talking about: purchase consideration, synergy benefit, exchange ratio. We are yet to discuss the questions on this. Exchange ratio, swap ratio, post merger number of share, post merger EPS, post merger market price. This is yet to come. Gain or loss in the EPS due to merger, equivalent EPS, gain or loss on market value due to merger. Now you will be able to connect with all these concepts. Once go through it and then you will get to know. In the next lecture, we are going to just increase the level of question with these concepts. See you, sir.